All right, the next exercise that we have is exercise 17-12, and that is a net operating loss. And in this case, we have the carry back. Now, the problem right this very minute, the tax law does not allow us to do a carryback, but I think I mentioned in the video where I was just giving an overview of the chapter, the part 2 overview of the chapter. I'm almost willing to bet, because we haven't had a widespread recession in a number of years. And so when Congress passed the law in 2017, December of 2017, that's when they took out the provisions for net operating loss carrybacks. And what a net operating loss carryback does, it allows a firm to get an immediate refund for past activities from the IRS. And so essentially what happens is that the government becomes a legitimate partner in your business. So they share in the gains, that's called taxes. And in this case, they share in the losses because they'll give you a refund in what happened in the past. Now, I'm almost willing to bet, that by the end of this year, 2020, they will put net operating loss carrybacks back into the tax code so that businesses will profit. Now, obviously, a lot depends on how long the recession that's anticipated is going to go on, and how deep and how severe it will be, which depends on how soon we get over this virus thing. But I'm just willing to bet that they put it back into effect to help out businesses. And so I want to show you how to do net operating loss carrybacks because of that reason. So in exercise 17-12, we have a company, and they in year one, they had a $120,000 profit, and they paid tax at a rate of 34%. In year two, they had a $70,000 profit, and they paid tax at a rate of 25%. And then in year three, they had a net operating loss, and the statutory tax rate in year three is 40%. So under the old law, we could carry back 2 years and forward 15. And so, and when they changed the law, the current law is back 0 years and forward 20. And so what we need to do is we need to figure out what is the tax benefit that we get by having this loss. And so when you carry it back to the most distant year possible first. So the loss is in year three. So we will carry it back to the $120,000 profit in year one. So year one has 120,000, and that, remember, is a tax rate of 34%, so 0.34. And if we multiply that out, that comes out to be $40,800. Okay, then that obviously doesn't use up all of the $280,000 loss, and so we go for the year two amount, and that is $70,000 in income, and that tax rate was times 25%. And when we multiply that out, we get 17,500 for that one. Okay, so we add that, we add this up, and that gives us 190,000. Remember, our loss was 280,000. So we've taken care of 190. We have 90,000 left that we will now carry forward. The carry forward on that, is going to be 90,000 times the statutory tax rate of 40%. and that's going to equal that's going to equal 36,000. All right. And so when we do that, we're going to have, now this amount will be receivable from the government. And so our entry there will be income tax, refund, receivable. And that'll be for that total amount. So that'll be for $58,300. Okay. Now this one is going to be a deferred tax asset. So we're actually prepaying our taxes by having a loss. And so that will be a deferred tax asset. And that will be for the 36,000. And the offsetting credit will be income tax benefit. And that will be those two combined. So that'll be $94,300. And that should balance if I did the math right. Okay, so now we have to ask ourselves, how much money did we actually lose? Well, we lost before taxes $280,000. But we get a tax benefit of $94,300. And so our actual loss, loss that we report to investors and creditors is $185,700. And that will be a loss. So this is the loss before taxes. This is the income tax benefit. And this is the after tax loss. Now, one thing I want to point out to you, you'll notice on there that the carryback was at 34% and 25%. A firm, even when we had the carrybacks, a firm could elect to not carry back and just carry forward. And if we do that, our actual tax benefit would have been larger. And so our loss that we show creditors and investors would have been smaller. So 40% of 280,000 would have been 112,000, I believe. Let me check that real quick. Yes, 112,000. And so we could have opted to do that, and that would have reduced our after-tax loss to $168,000. So that's a possibility that you have to consider. All right, so that concludes exercise 17-12.